Well, joining us more now is Scott Phillips from the Motley Fool. Scott, great to have you, and what a very busy week. Tumultuous, you could say, given obviously the US election result. And of course, this morning we've had that decision by the Fed. How do you approach it all as an investor?
Mate, good morning. And yeah, we can spend hours on this, right? And still only touch the surface of what's happened this week. It's been a really, really big one. It won't surprise you to know, Andrew, and I hope it won't surprise your viewers. I'm a long-term investor, mate. And so all I'm really asking myself is what happened this week is impactful on my long-term investing thesis. And the really simple, it's almost too simple, but the really simple test is in 5 years' time, how much of this will still be an issue positively or negatively for the companies or the markets overall? And that's kind of the only question you need to ask yourself, right? There's always going to be volatility, but if you're a long-term, look, if you're a trader, you can trade that volatility if you think you know what you're doing. If you're a long-term investor, it's just noise. Are these businesses going to be bigger, better, more profitable, more successful with brighter futures in 3, 5, 7 years' time? 5 years is probably a good time, actually, mate, because that's going to be the end of Donald Trump's second term. Not that I'm necessarily saying it'll be a bad one, just if you're thinking about the politics, the question really is at the end of that term when someone else takes over, whoever that is, are you going to be in a decent position? Are you going to be happy you held these company shares today at today's prices? And that kind of lets you put a whole lot of noise aside, really focus on the things that matter. What are the fundamental contributors to a company's sales, to its profits, to its cost base, to its competitive advantage? Focusing on those is how I get through some of the volatility like the last week.
Well, of course, it remains to be seen what Donald Trump will bring to the table when he assumes office and how that's going to affect us, because there's so much talk about global trade that could be significant for us if it sparks a global trade war, particularly the impact on China and therefore the flow-on effects for us. Does that concern you to be mindful of that, particularly, I guess, in terms of our top exporters and the resources?
Yeah, 100%, mate. And this is so when I ask that question of myself, I'm far less sure of that answer for our exporters than I am for our domestic companies or our importers or businesses that have global customers or customers that are outside the US. So you're exactly right. Look, Andrew Irvine from NAB has expressed concern. I'd echo that concern, not that he needs my support, but the reality of a 10% tariff, if it does come to pass, on every Australian product going to the US, and again, China, our larger trading partner, if China exports or imports into the US are subject to a 60% tariff, then yeah, it is absolutely going to hurt, almost certainly going to hurt. Now, companies, markets will, physical markets here, not financial markets, will rebalance. They'll find a way. We've had that issue with tariffs with China, right? We've been there, done that. We've found a way to get through it. But that being said, it was very painful. Think about the winemakers, think about the seafood farmers, if that's what they're called, harvesters. There've been very specific areas where there has been some pain felt. These tariffs, in theory, are across the board. It applies to all other countries importing into the US, so it's less a directly competitive situation. I also suspect, mate, we don't yet know, and this is as you say, Donald Trump's all about slogans, right? There's very, very little detail. So is he going to do it at all? We don't know. How long will it take? We don't know. Will he allow exceptions for friends, and whether we follow that category or not? And we also know Donald Trump's very transactional, right? Will we be able to negotiate our way out of that by saying, look, we're a mate, you're a mate, we'll give you this, you give us that. That argy-bargy is certainly going to be part of a Donald Trump presidency, as it was the first time around. So there's two challenges here, mate. One is, if you draw that line and say what could happen, how bad could it be? In a worst-case scenario, pretty bad, especially for specific businesses, exposed businesses, resources directly. That's all absolutely true. The thing is, if you then go back and say, well, what are the range of options? How likely are they? How long do they last? How big is it? What other substitutions have we got? That's far less certain. And so you are in that really interesting place. I own shares in Fortescue, by the way. I'm probably less keen valuation-wise on that than I was 2 days ago, 3 days ago, just because of that potential reality. So if I look at the 2029, I said 5 years before, if I forecast that and go, how big is it? How profitable is it in the meantime? Where does it get to? I don't really know. I really don't know. Here's the other thing, by the way. This is a crazy brave experiment, right? And if it either works, frankly, or if it doesn't work but everyone else copies it anyway, we're up for trade barriers around the world. And so we talk about the US, we talk about exports to the US or to the US via China. If this becomes a tit for tat, if Europe puts tariffs on the US puts tariffs on, if we have this back and forth, they have a very, very, very different scenario when it comes to trade exposed industries right around the world, not just Australia to the US, Australia to China, but potentially between and among countries in trading blocks. So there's a lot of water to go under the bridge here. The other thing I suppose most important is if you don't know, trying to guess is not necessarily particularly productive, right? What could happen? I don't know. Could be great, could be terrible, could be somewhere in between. If you don't know, trying to respond to it just because you feel like you should is probably a mistake for most investors. You're probably able to say, I don't know, I didn't know yesterday, I didn't know tomorrow, I don't know tomorrow. Who knows what's going to happen? I'm going to wait and see. If I get offered an opportunity to buy or sell at an attractive price, given that uncertainty, I might take it. I mightn't pay as much for iron ore. I mightn't pay as much for an Australian exporter who sees the US as one of their biggest markets. That's probably not, you don't pay as much for those companies just on the risk, but don't bake it all in entirely. Don't assume it's going to happen unquestionably and the impact is going to be terrible. It might be. By the way, another good reason to be diversified too.
Scott, meanwhile, look, locally we continue to get corporate updates, which is important in the immediate term. With the banks, in fact, ANZ out this morning. What have you seen with some of the banks and their updates and how they're travelling at the moment?
Yeah, look, I think we know times are really tough for our banks, right? They're really struggling to get profit growth. We've seen Westpac and NAB, Westpac down 3, NAB was down 8. We've seen NIM, net interest margin compression across the banks, and that's been an ongoing process. I think it's kind of tempting to think, as a consumer, if you listen to people talk, there's always this talk about, banks aren't competitive, it's an oligopoly. That's kind of true on one level, right? It could be more competitive for sure, but the net interest margins over the last, I'm going to say 7 or 8 years, have kind of been this consistent downtrend on average. In other words, the bank's keeping less and less and less and less of each dollar of assets they transact or they hold on our behalf. Now, part of it's because the businesses are growing, but they're not able to hold or grow their profit margins. So there is a sense of competition there, whether it's competition for depositors' funds or for wholesale funds, whether it's competition for mortgage lending or business lending, whether it's the cost of running those branches and the ATM networks we've talked about so regularly. The banks are not in particularly great health when it comes to growth. They're fine, they're solid, they're safe, they're great. But you've got to look at these businesses. A lot of people, frankly, are paying growth multiples for businesses that are in decline. And you've really got to ask yourself, is it a case of Tina, there is no alternative? Is it a case of, well, at least I know it? Is it a case of just set and forget? I don't know. But I've got to say, some of those multiples, I've said this before, I'll keep saying it, some of those multiples that you would apply to a growth business that are being paid for banks that are going backwards doesn't make a lot of sense to me. If you're generous, and maybe if I'm wrong, the future is really bright and people are paying a high price because 2025, 2026 are going to be wonderful years. And hey, it's possible if rates start coming down, maybe things start to change. Remember, of course, that higher rates are supposed to be good for bank margins. Lower rates are supposed to compress bank margins. So it would be a brave person who would say, look, margins are coming down now, but they're going to go up once rates start to fall. It's possible, but I wouldn't expect so. So just be careful how much you pay for these banks. As I said, as institutions, they're fine. By the way, we heard CBA earlier in the week is going to start advertising in branches, on ATMs, probably on the internet banking portals. They're basically trying to become it's not a media company, an ad-supported company. Think about Netflix, right? We used to pay for that. Now we've got to pay for it and get some ads as well. That's kind of what's happening with CBA. They've said, well, banking's not making us enough money. There's no growth there. What if we get some ads and show some ads while people are in the branches? It's a really interesting decision, mate. It does go to show, I'll say desperate. I don't mean desperate again in a horribly dystopian way, but desperate for growth. They're looking around going, well, we can't grow what we're already doing. Let's throw some ads up, see if that'll make us some money. It kind of tells you the story of the future of banking, I think, in Australia.
Goodness, the banks are doing that. Where's that leave the media companies who are really struggling at the moment? Hey, Scott, just before you go, other big news out yesterday, of course, the ACCC finally approving that deal between Sigma and Chemist Warehouse.
And Sigma shares rocketing on the news, no surprise there. This is a backdoor listing in the of the old style, right? Sigma Healthcare is a fine business. Chemist Warehouse is an amazingly good business. Now, the price is going to be an interesting question. I'm not sure I necessarily want to buy the shares, but Sigma is a more valuable business with Chemist Warehouse as part of that deal rather than without it. And that's why you saw the share price absolutely jump yesterday. Chemist Warehouse is an amazing retailer, mate. Not as much because, maybe even more because they're in a really anti-competitive sector. The rules around ownership, geographic locations, what you can and can't do in pharmacy have made this a really, really staid and boring and anti-competitive industry for decades. Chemist Warehouse has bought the competition, really upset the apple cart. It is going to keep growing. It'll now have the cost benefits and synergies of having its own vertically integrated wholesaling and retailing operation. That's got to be good news for the business itself. So I see better times ahead for Chemist Warehouse. Again, I'm not saying you should necessarily buy the Sigma shares at the current price, but this is a juggernaut of a business. While ever, and this is a big one, while ever Woolies and Coles are prevented from playing the pharmacy game, Chemist Warehouse is in a good position. The big watch out for anybody investing in these shares, and look, government are under the thumb of the pharmacy guild, so it may not happen, but if and when any government lifts that barrier and says, Woolies and Coles, fill your boots, going to be a very, very different business. So if you are looking at shares in this one, just be careful. Again, no predictions, no promises. The government so far has been very keen to protect pharmacy rather than open it to competition. But if it ever does, the mechanics and the dynamics will change really quickly.